Hello, this is Guan Invest. Today I'll be talking about stocks that I'm looking to buy soon. So the first stock that I'm talking about today is PayPal. So PayPal is currently trading at a 17 PE, a 13 forward PE, and the stock is down around 20% year to date. So they reported earnings and they had declining revenue growth, and that led to the stock dropping 20%. So PayPal now, I think, is presenting a decent buying opportunity right now because as you can see over here, revenue has been growing steadily, earnings has been growing steadily as well. And then overall, I think PayPal is a maturing business, of course. Their growth is slowing, but it is not a business that has zero growth in it. So the markets are now pricing it like it's as if PayPal has no more growth already. So the story for PayPal is extremely simple. PayPal just needs to buy back a lot of shares, which it has done in the past year or so. So as you can see, 6% decline in the shares outstanding. And if you were to look at PayPal's price to free cash flow right now, it's around a 10. So that is a historical low in terms of its valuation in the past few years. The PE as well is extremely low, it's at a 17. It's nearing the low end already, which is in 2023 when it was at, I believe, 15 times, yes. Correct. So I think PayPal now is presenting a decent buying opportunity right now. You could easily have a 6% revenue growth, 6% buyback yield. That would be a 12% already. And if PayPal can grow at around 12%, the market will likely re-rate it to around a 20 times earnings, which will lead to maybe a 15 to 20% CAGR over the next 5 years for PayPal. So I think PayPal right now is presenting a decent buying opportunity. You can look into it. I'm personally looking to add into it maybe around the $63 mark, where it is at the next support level when it is around 20% undervalued. Okay, so the next stock that I'm looking at right now is Amazon. So Amazon currently is down around 13% in the past month, and year to date is down around 5%. So I think this stock right now is presenting a decent buying opportunity if you are looking at a Max 7 stock. Currently it's trading at a 32.4 PE. I think it is very reasonable for a company that has as much growth as Amazon. And over the past few years, revenue has been increasing steadily and net income has been exploding as they transition from growth to profitability. So Jeff Bezos, after Jeff Bezos stepped down, a new CEO came in. His name is Andy Jassy. He's a lot more practical. He's more geared towards profitability rather than just in reinvesting for growth and growth and growth non-stop. After all, Amazon is already a $2 trillion company. There is only that much growth ahead of it. It cannot just grow until perpetuity. So for Amazon, I think the story is extremely simple. So Amazon has a few different businesses running for it. It has its retail business, subscription business, third-party seller services business, and then your normal online stores. And the most important part of Amazon's business is the AWS business. So the AWS business currently makes up around 57% of their total net income, and I expect that to continue in the future. And AWS will just continue growing at around a high teens to a mid-teens level. And if Amazon can sustain that level with the 31% market share that they currently have now, I think this story is an extremely compelling one. And then another portion of this story will be margin expansion. So in 2023, everything else apart from AWS had a 2.5% operating margin. And then in 2024, it was 5.4%. So the margin doubled in a year, and I expect that to continue doing so. I expect them to continue doing so over the next few years or so, as they increase their profit margins for all the different high margin businesses like your advertising, third party seller, and then all your different subscription business as well. So AWS will continue to maintain the profitability, and then everything else will increase the profitability even more by increasing margins. And that's the story for Amazon. So let's take a look at a bit of valuation for Amazon right now. So Amazon currently is trading at a stock price of $208, and the EPS is 5.53. So over here, Finviz is projecting Amazon's earnings to be at about 19%, 20% over the next 5 years. But I'm a bit more conservative, so my upper limit will be around 15% EPS growth over the next 5 years. And assuming Amazon's multiple contract to about 30, currently is at around a 36, Amazon can give you around a 9.9% CAGR over the next 5 years. So this signals that Amazon right now is trading at around fair value for me. But if you were to bump up the EPS estimate to around a 20% EPS growth over the next 5 years, then Amazon is extremely undervalued. This is a double in 5 years. So I think Amazon now is presenting a decent opportunity. You can look into it. So the third company that I'm looking at right now is a compounding machine. It is a company that has almost a monopoly in the index business. So this company over here is MSCI. Year to date is down around 5%. It is down around, I believe, 15% from its highs. So this company is currently trading at a 40 times earnings, a 33 times forward earnings. It is not super cheap by any metric, but I think it is right for you to pay up for a compounding machine like MSCI. So what exactly does MSCI do? MSCI comes up with the indices for all your different asset managers to benchmark against. So you have your MSCI Emerging Markets Index, you have your MSCI Global Index, MSCI China Index, and all your different MSCI indexes. So all these asset managers, they need a benchmark. So they'll pay MSCI to sort of like gain control of the license of the MSCI index, and then they'll basically just benchmark their hedge fund performance against the MSCI. So MSCI over here is growing revenue at around between 10 and 12%. So it's been growing revenue around 10 to 12% for the past 3 years or so already. And in the 2022 drawdown, in the 2022 stock market crash, as well as the 2020 COVID crash, MSCI revenue grew in those 2 years. So this shows that despite the market turbulence, MSCI is still a very resilient business. So if MSCI can grow its revenue at around 12% and it can increase its margins by around 2 to 3%, that could easily be a 12 to 15% earnings growth over the next 5 years for MSCI already. So over here, net income dropped. This was because of a one-time expense. But if you have to look at the adjusted earnings, MSCI's adjusted earnings grew by 12% this year, and I expect them to continue doing so over the next few years. So if you have to look at some valuations over here, I know the PE was a bit inflated, but look at MSCI's price to free cash flow right now. It is currently trading at a 30 times price to free cash flow. That is one of the lowest valuation for MSCI in the past few years or so. So I believe paying up for a quality company like this is decent, and it is now in a 15% drawdown. So it's presenting a decent buying opportunity right now. And another thing, there's been some insider trading for MSCI. The company CEO, Henry, he bought a large stake in MSCI a month back. So he usually buys it quite well. He bought it when MSCI was trading at around $440 as well, when they had a big dip over here. So he's now buying the stock again because he believes that it's undervalued. So I believe it is a decent buying opportunity right now for MSCI. So let's take a look at some valuation for MSCI. So MSCI over here, I'm using a DCF calculator. MSCI is showing that it is around fair value right now. So my ideal entry for a starter position, maybe a 20% position for MSCI, in terms of allocation, is around $500. I believe at $500 it will present a very, very good opportunity, and yes, that is the price that I'm looking to get. Last stock that I'm looking at right now is Microsoft. So Microsoft is a simple story. It is one of the most predictable businesses out there. It is currently flat in the past year, so I expect the price to move up a bit more. But besides the price action, this company is an extremely durable business. It's basically a buy and hold forever stock. So revenue has been growing 15% over the past 5 years. In the 2022 drawdown, in the 2022 tech crash, Microsoft grew its revenue by 17%. 2020 as well, it grew by 13%. So that just shows how predictable and how durable this business is. So Microsoft is currently investing a lot of its money into CapEx. So they're expecting CapEx, basically the CapEx AI spend to pay off in the long run. So I do believe that it will pay off in the long run, because you have 3 different CEOs doing the same thing. Either they're all 3 idiots or they're the 3 geniuses out there. And I'm leaning towards the portion that they are all 3 geniuses. So Microsoft right now is currently trading at a 30 times earnings. So I did a bit of a valuation for Microsoft. So Microsoft over here, if its current stock price is around $400, it went up slightly already from the time where I added a bit more of Microsoft. So at $400, if it holds a multiple of 26 times, you can expect a 10% CAGR over the next 5 years. So this signals that Microsoft is basically around fair value now if the terminal multiple is around 26 times. In the 2022 tech crash, Microsoft's price to earnings dropped to around 24 times. That was the lowest point. So I believe 26 times is quite okay. The next valuation metric will be around 28 times. So if it can grow to around a 28 times price to earnings, then it will give you around an 11% CAGR. That is quite decent for a company as big as Microsoft. And then if you believe that it can hold its multiple at 30 times, then Microsoft is undervalued today, giving you around a 12% CAGR. So I do believe Microsoft is one of the best businesses out there. Microsoft is one of the most entrenched software businesses, and it is able to bundle everything up the best. It is the company that's able to do so, and I believe that they can continue doing so over the next few years. And that's why I started a position in Microsoft when it dropped to around $385.